Why the heck is this dude reading? I don't know. Why not? Chapter 3, My Abyss, 1979 to 1982. From 1950 until 1980, debt, inflation, and growth moved up and down together in steadily larger waves, with each bigger than the one before. Especially after the dollar's link to gold was broken in 1971. In the 1970s, there were three such waves. The first came in 1971 as a result of the dollar's devaluation. The second, which came between 1974 and 1975, took inflation to its highest level since World War II. The Fed tightened the money supply, driving interest rates to record highs, which caused the worst stock market and economic downturn since the 1930s. The third and largest wave came in 1979 to 1982 and was one of the greatest economic market crescendos and reversals since 1929 to 1932. Interest rates and inflation soared and crashed. Stocks, bonds, commodities, and currencies went through one of their most volatile periods ever, and unemployment hit its highest level since the Great Depression. It was a time of extreme turbulence for the global economy, for the markets, and for me personally. In 1978 to 1980, as in 1970 to 71, and in 1974 to 75, different markets began to move in unison because they were more influenced by swings in money and credit growth than by changes in their individual supply-demand balances. These big moves were exacerbated by the oil shock that followed the fall of the Shah of Iran. That oil market volatility led to the creation of the first oil futures contract, which gave me trading opportunities, bracket open. By then, there were future markets in the interest rates and currencies as well, and I was making bets in all of them, close bracket. Because all markets were being driven by these factors, I immersed myself in macroeconomics and historical data, open bracket, especially interest rates and currency data, close bracket, to improve my understanding of the machine at play. As inflation began to rise in 1978, I realized the Fed would likely act to tighten the monetary supply. By July 1979, inflation was clearly out of control, and President Jimmy Carter appointed Paul Volcker chairman of the Federal Reserve. A few months later, Volcker announced that the Fed would limit the growth of the money supply to 5.5%. According to my calculations at the time, 5.5% money growth would break the inflation spiral, but it will also strangle the economy and the markets and likely cause a catastrophic debt crisis. A silver roller coaster, bold. Just before Thanksgiving, I met with Bunker Hunt, then the richest man in the world, at the Petroleum Club in Dallas. Bud Dillard, a Texan friend and client of mine who was big in the oil and cattle businesses, had introduced us a couple of years before, and we regularly talked about the economy and markets, especially inflation. Just a few weeks before our meeting, Iranian militants had stormed the US embassy in Tehran, taking 52 Americans hostage. There were long lines to buy gas and extreme market volatility. There was clearly a sense of crisis. The nation was confused, frustrated, and angry. Bunker saw the debt crisis and inflation risk pretty much as I saw them. He'd been wanting to get his wealth out of paper money for the past few years. So he'd been buying commodities, especially silver, which he had started purchasing for about $1.29 per ounce, as a hedge against inflation. He kept buying and buying as inflation and the price of silver went up, until he had essentially cornered the silver market. At that point, silver was trading around $10. I told him I thought it might be a good time to get out because the Fed was becoming tight enough to raise short-term interest rates above long-term rates, bracket open, which was called inverting the yield curve, close bracket. Every time that happened, inflation hedged assets and the economy went down. But Bunker was in the oil business, and the Middle East oil producers he talked to were still worried about the depreciation of the dollar. They had told him they were also going to buy silver as a hedge against inflation, so he held on to it in the expectation that its price would continue to rise. I got out. On December 8th, 1979, Barbara and I had our second son, Paul. Everything was changing very fast, but I loved the intensity of it all. By early 1980, silver had gone to nearly $50. And as rich as he was, Bunker became a lot richer. While I had made a lot of money on silver's rise to $10, I was kicking myself for missing the ride to $50. But at least by being out, I didn't lose money. There are anxious times in every investor's career when your expectations of what should be happening aren't aligned with what is happening, and you don't know if you're looking at great opportunities or catastrophic mistakes. Because I had a strong tendency to be right, but early, I was inclined to think that was the case. It was, but to have missed the $40 move up was inexcusable to me. When the plunge finally did happen in March 1980, silver crashed back down to $11. It ruined Hunt, and he nearly brought down the whole US economy as he fell. The Fed had to intervene to control the ripple effects. All of this pounded as indelible lesson into my head. Timing is everything. I was relieved that I was out of that market, but watching the richest man in the world, who was also someone I empathized with, go broke was jarring. Yet it was nothing compared to what was to come. Expanding the team, bold. Later that same year, a great guy called Paul Coleman joined Bridgewater. We had become good friends from our dealings in the cattle and beef industry, and I respected his intellect and values. So I convinced him we should conquer that world together. He brought his wonderful kids and wonderful wife and kids up from Guymon, Oklahoma, and our families became inseparable. We ran the business in a scrappy, seat-of-the-pants way because the office part of the brownstone where I lived and worked was generally such a mess. With chicken bones or other scraps from working through the previous night's dinner littering my desk, we held all our client meetings at the Harvard Club. Paul would hide a clean blue Oxford shirt and tie amid the mess, so I'd have something to wear. In 1981, we decided we wanted to raise our families in more of a country setting, so we all moved up to Wilton, Connecticut, to run Bridgewater from there. Coleman and I worked by challenging each other's ideas and trying to find the best answers. It was a constant back and forth which we both enjoyed, especially at a time when there was so much to figure out. We would debate about the markets and the forces behind them late into the night, plug data into the computer before we went to bed, and see what it spit out in the morning. My big depression call, bold. The economy was in even worse shape in 1979 to 1981 than it was during during the financial crisis of 2007-2008, and the markets were more volatile. In fact, some would say this was the most volatile period ever. The charts opposite going back to 1940 shows the volatility of interest rates and gold. As you can see, there had been nothing like it prior to 1979 to 1982. It was one of the most pivotal times in the last 100 years. The political pendulum throughout the world swung to the right, bringing Margaret Thatcher, Ronald Reagan, and Helmut Kohl to power. Liberal had ceased to mean being in favor of progress and had come to mean paying people not to work. As I saw it, the Fed was stuck between a rock and a hard place. They either had to A, print money to relieve debt problems and keep the economy going, open bracket, which had already pushed inflation to 10% in 1981 and was causing people to dump bonds and buy inflation hedge assets, close bracket. Or B, break the back of inflation by becoming bone-crushingly tight, which would, open bracket, which would break the back of debtors because debt was at the highest levels since the Great Depression, close bracket. The worsening problem showed up in both progressively higher levels of inflation and progressively worse levels of economic activity. Both appear to be coming to a head. Debts continued to rise much faster than the income borrowers needed to repay them, and American banks were lending huge amounts, much more than they had in capital, to emerging countries. In March 1981, I wrote a daily observation entitled "The Next Depression in Perspective," and concluded it by saying, "The enormity of our debt implies that the depression will be as bad or worse than that witnessed in the 30s. Okay, next chapter. Wait, no, sorry, not next chapter. Next page. Don't know if you guys can read this. Yeah, just a graph. You guys can just see it. You're probably listening to this in the car, but it's my job to show. This view was extremely controversial. To most people, depression was a scary word used by kooky and sensationalist people, not something thoughtful people took seriously. But I had studied debt and depressions back to 1800, done my calculations, and was confident that the debt crisis led by emerging countries was coming. I had to share my thinking with my clients because my views were so controversial. I asked others to track my reasoning and point out to me where it was bad. No one could find any flaws in my logic, though they were all reluctant to endorse my conclusion. Because I believed that the choice was between accelerating inflation and deflationary depression, I was holding both gold, open bracket, which performs well in accelerating inflation. All right, that's it for today. If you guys enjoyed that, you guys can probably listen to this while you're driving in the car. And yeah, I mean, if you read this book before, then I think you could listen to it as an audiobook. But yeah, I go page by page. I'll probably make a playlist when I finish reading this book, of just like me reading it out. But yeah, why am I doing this? Maybe I just want to read, I guess, and I want to document the whole thing. I just thought of it, and I was like, why not just read a book out loud and take a video while you're doing it? Sounds like a funny idea, so might as well just do it. Sometimes you just gotta take action. And yeah, I'll see you guys. Peace.